Are you an American or green card holder that owns foreign real estate property? Well, if you have, you need to know what depreciation is and how it can help you reduce your US taxes that's paid to the IRS. Go check it out. Hi everyone, my name is Simon Mishevich from Optimized Accountants, and in this video I'm going to be talking about Americans or green card holders that own foreign estate property and need to depreciate their assets, and what happens to that depreciation when you sell the property, known as depreciation recapture. So I'm going to cover off the basics in this, but if you have any questions, feel free to type those questions into the comments box. I will get back to you. I think it's really important for you to read this IRS publication 527, which talks about residential rental property. In that very detailed workings, they talk about this, which is depreciation is a capital expense. So typically you're buying an asset, which is a building, not forgetting that land in this regard is not taken into account as capital for depreciation purposes. So if you're buying a foreign estate property, you need to split out the building from the land. That's my building, by the way, and the land. Pretty pathetic. But you have to split that out for depreciation purposes. That's not common when you're in the UK or a lot of other countries for that matter. So depreciation is a capital expense. It is a mechanism for recovering your costs in an income producing property. So you get rental income, so the Americans give you this depreciation charge to help you reduce your US tax liabilities. And it must be taken over the life expected of the property. And we'll cover that in a second, because I do see a lot of mistakes being made around depreciation on 1040 tax returns that I see from other CPAs and EAs. And I'll talk about that later on, especially when it comes to foreign assets. So here we are. So if you're an American buying foreign estate property, you must use something called an alternative depreciation system, which is ADS for short. Typically, the building itself would be depreciated over 30 years. So for every year in the property, you get 1/30th as a tax deduction called depreciation on that asset. We'll talk about some other things now, because this is where the mistakes are made. Typically, you could accelerate depreciation of your property, the things that's inside of it. So things like, as it says here, stoves and refrigeration. So anything mechanical in your property could well fit into this category, which is depreciated over 9 years, not 30 years. So you're getting a quicker accelerated cost deduction against your 1040 tax return income. Carpets, furniture, etc. is all 9 years as well. Office furniture and equipment, though, is slightly different, whereby you've got an ADS depreciation lifespan of 10 years. So you would take that 10 years, you divide the asset cost over 10 years, and then put that into use. Any other property class is 12 years. So you've got other items. You think, well, where does this really fit in? Do check out that manual as I talked about earlier. If you can't find the classification of that particular asset, then you can use the 12 years rate. And typically I would say that a couple of mistakes are made here, that the EA CPA has just lumped up all your costs and depreciated it over 30 years, or indeed the person that owns the real estate property in a foreign country has not categorized those costs to help the EA CPA accountant to do the right tax deduction. There's another one for fences there. Again, that's 20 years as opposed to the 12 years we mentioned earlier. Now, what I want to talk about is if you sell a property, what happens to the depreciation? That's what this is all about. It's called depreciation recapture. So it's worth you reading the IRS publication 544, Sale and Other Dispositions of Assets. We're going to focus very much on the sale of an asset, but do read that. It's really important. In there is an example whereby you've got the amount realized, which is the cash of 100,000 fair market value of the property received. So if you've got any property exchange, so someone gives you not just cash, but they also give you other types of assets, then that obviously adds to what you have got. Real estate taxes assumed by the buyers. If they're paying the real estate taxes, they take that. And mortgages assumed by the buyer. Again, you've got to think about not just the money you receive, but all the liabilities that the buyer takes from you that will have to be taken into account. So in this regard, we're talking about $140,000 received. Of course, when we're thinking about foreign assets, you might have to convert from UK pounds from euros into dollars, or in Asia, you might have Hong Kong dollars, etc. All of which needs to be converted on your sale. Now, you'll get most of that from your completion statement, and then you could pop your numbers into your own 1040 here. Now, that's only money received. So what happens to the rest of it? Well, what I've done is we've got then minus selling costs, which gives you $136,000 left over. But then you got the cost of the building, $70,000, improvements, $20,000. So this is all on your balance sheet, don't forget, on what the cost of the building was. So you got $90,000 there. But you may have depreciated that asset. Don't forget that building would have been depreciated over 30 years, some items over 9 years, 12 years, 20 years, etc. So now you've got this $10,000 depreciation charge, which may have been a waste of time, especially if you're in a high rate tax paying country as opposed to a low tax country such as Hong Kong, where depreciation is quite useful, not in the UK. But nevertheless, in this regard, you've now got the adjusted basis of 80,000. So we're taking now this value to get a gain of 56,000. Now that would be a natural gain, and you always think, well, how is this taxed? Well, it's going to be split. Funny enough, you're going to have this income that will be taxed at typically 15% capital gains tax if you're earning circa less than $500,000, I would say. Broad brush, make sure you check out those numbers with your CPEA and accountant first before you take that 15% as read. So most people would think, well, okay, I'm being charged 15% tax, that's the end of it. Not really. You'll notice that we've got this depreciation charge of $10,000. Well, actually, that's going to be ordinary income. So that ordinary income is going to be taxed at different rates. It could be scaled to the 37% tax rate. So you might have sold your property, but because you've had this depreciation, and don't forget, if you're in a high rate tax country such as the UK or Spain, for instance, then this depreciation was a real waste of time. You're not getting any tax benefits by depreciating your asset. But the IRS assumes that you have depreciated the asset even if you've not taken the tax deduction in the year that you were depreciating the asset. So even if you said, well, I'm not going to depreciate the asset, the IRS don't care about that. When you sell, they will still want you to do the calculation and say, well, what would the depreciation have been? Take that as a deduction, and now you take that recapture rate and you pay the normal banded tax rates to IRS as though it's income. So you may not have paid any capital gains tax on a property because you may not have made a gain. But now, because you got this depreciation charge, you would then fictitiously make this gain, and you will be taxed as income on that particular depreciation charge. So it could well mean that you are going to pay tax in the United States to the IRS for a disposal of a foreign asset, which is quite costly if you do not get it right and the IRS investigates that particular transaction. Hopefully that video was useful for you, but please do not stop there. There are plenty of videos that I know that will help you build your wealth whilst reducing your tax liability. And in this video, well, this is the one I think you should be watching right now.